it, and you will get the download link for the newest update here. Guys, when you understand this concept, and this is really known rocket science, it won't cost you any cent. You will be a winner. You will be a winner. Ladies and gentlemen, every one of you, if you are following and allow yourself to dive a little bit more into this concept, you will be a winner. And I will give you a nice, interesting task for the next days or for the next weeks. I pointed out in my presentation, my video, and what I'm writing is that I personally don't like guessing. And I'm saying here very openly that guessing was yesterday and trading is now. That's not marketing stuff. That's not marketing bullshit. That's really what I strongly believe. Guessing, no trade, don't guess. I would like to motivate you, and by saying following. We all are, let me say, kind of addicts. That means we are addicted to indicators, we are addicted to charts, we are addicted to systems, whatever, because we need that. We need lines, we need indicators, we need more lines and other charting programs, you name it. That's what we want, what we need, because our inner monkey, you remember the discussion of what I said on Monday with this wonderful book, The Chimp Paradoxon. Chimp Paradoxon, I would recommend as well. Buy it, read it, it's extremely well. It does not apply to trading. Trading is only a very, very tiny part of probably our life. But when we think about trading, then we have to come to a situation where we have to silence our inner monkey to say, okay, everything is good. This addiction where we are saying, okay, I need a line more, I need an indicator more, I need a chart more, I need a signal more, is simply the point that we need to silence our fear center in our brain. You remember the amygdala, when you read about that, this is our fear center, and our fear center protects every one of us, every individual on this planet, to protect to die from dying or from accident or whatever. That's really easy to understand. We have a protection system, a self-protection system. I would propose to you in this case, and I call it a chart and indicator detox week. You might laugh now or be astonished, and maybe something a little bit weird to you, it's a little bit I don't know, but I would propose a chart and indicator detox week. Or rehab week. I like more the word detox. That is hard, Walter. Yes, it is. And but let me just tell what I mean by that. As we have discussed this week, for example, Raimo and I, this is a stop run, and I'm saying, I'm very, very cautious with stop run. Zoom in and see if this really a stop run. We simply addicted to any kind of signals. That's a huge multi-billion industry out there with chartings, with signals, with whatever add-on systems, whatever you want. This is a huge industry. Everyone wants to tell you he has the best instrument. And by chart and indicator detox week, I mean that you should reserve 1 week, 5 days, only 5 days, ladies and gentlemen, 5 days. That's not much. 5 days. You see how fast, yeah, it gives you the best. I'm just got distracted here. This is written to you alone, but okay. Okay, good. I would like to motivate you to do this chart and indicator detox week. 1 week, 5 days. Subscribe to the CBO DX or CBO data to receive VIX, VXX, and so on. And put only 2 charts. Put only 2 charts. Such a chart, this chart, and excuse me. Or similar chart, if you have Sierra, whatever. Sierra, whatever, and a bookmap chart. And maybe an add-on like TradeFinder or whatever you want to have here. And watch only those 2 charts using the UV, using the VXX, the VIX, and so on. That's all what I would like to propose or suggest to every one of you. Oh, excuse me, so going back. 1 bookmap chart with bookmap and a chart with SPY, VIX, VXX, and UV and HYG. Leave all your other charts closed, all signals closed. Don't look at any other signals for 1 5 week, and see what does this suggestions make with you. Then when you got this week, this detox week, I call it detox week, come back and use whatever you want, but try and see to understand the big picture, to see the big picture. Fine tune your entries with bookmap and TradeFinder, and you we'll talk about in a few minutes about optimizing the risk-reward ratio. And what I wanted to discuss, maybe it's always important point, that we are spending a lot of money for charting programs, for indicators, for whatever services, and it's as well important to understand if we need everything of this expenditures for every signal indicator or whatever. That's really important. I have had a discussion with several traders here. They're spending 500, 600 dollars for bookmap, and that's really they are not successful with bookmap, of course, and so on and so on. So save in money, and yes, you lower your trading expenditures, because you don't need really many or much indicators for to be successful in trading. And what my goal is here: achieve happiness in trading. Achieve happiness in trading. That's if you are not if you are not happy what you are doing in trading, then something is wrong. Rethink that. That's my advice. And be successful. Allow yourself to do this detox week, 5 days, and then see what is the result at the end of the week. If either you can work with this approach, with this charts, or you can't. That's or you can find a mix between this approach and your personal approach, with maybe you have market profile, volume profile, footprint, or whatever. It's really not hard. Just observe, sit back and observe. And either you will see what happens, and then you can transform this knowledge into your trading experience. Or maybe this is really something really strange, and that's something you should then retreat and find your own way. Any suggestions or ideas? Should we do, ladies and gentlemen, a test? Let's do. There is no Levi. There is no indicator for detox. What I'm saying, Levi, is following. Close all your charts. Watch the SPY, the VIX, VXX, UVXY, and the suggested high yield bond and put your ES chart on the second screen and simply watch those both screens or charts. Nothing else, really nothing else. No single indicator, nor not an divergence indicator, not an RSI, not a moving average, nothing. Simply a clean chart. Simply a clean chart. Levy. There's no indicator. We don't, guys. I provoke you. I know. And I do it consciously. Normally we don't need indicators. We have liquidity for stocks. That's a good break. That's the most important one. And then we have this wonderful correlated markets, which costs us nothing. Costs us nothing because either we have them, or maybe we should subscribe to CBOE. You can do that by Kinetic is providing the data. I'm sure IQ Feed as well. Every other provider does provide CBO data, DX Suite as well. That's all what we need. And then go back, sit back, watch what happens. That's my suggestion for the detox week. I would like to do a test with you, maybe just for fun and just to keep you awake. Yes, Julas, yes, of course, you are right. Sorry for that. The detox week, you can add as well. Yes. Good point, Julas. You can add. I just have the SPX here on this chart. And I'm watching the tick and TRIN and ADD. Yes, you're right. So when you see ADD coming down, minus 800, minus 1300, that's the broader market advances and decliners, NYSE advances and decliners. You have them as well for the NQ. Then they will get you another idea. But you see on my chart, I don't have any indicators here. I don't need them. I have the reading. Okay, the market is more to the downside. The ticks are negative. The SPX is down, the VIX is rising, coming to a retrace here and maybe rising again here. We will see that. But that's all what we need. If you want to have ADD and tick and TRIN, yes, they are absolutely helpful. It can complete, yes, it will complete the picture when you understand what's behind ADD and tick and TRIN and so on. Of course, yes, Julas, good point. Thank you. Okay, let's do a test. Maybe some of you know this test. I am aware what I'm just going to show you. It's an attention test written by. Sorry.
So it's you probably ask us a question after that.
Yeah. I just let me show you what I want to do with you here is following. Sit back, relax. Sit back and relax. You will see players here in this short, very short video. It's only about 30 seconds. And your solely task is to count how many times the players were wearing white pass the ball. So you will see white and red players, and you should simply sit back and counting the white wearing the white players with the white t-shirt. They are passing the ball, and count how many times the players wearing white means white t-shirts or shirts pass the ball. Okay? Let's see. So are you ready? Lean back, relax, and go ahead. So just to this 3 ladies here in white, and there are 3 ladies in black. They will simply play the ball and pass the ball to each other here, the white to the white and black to the black. Please focus yourself and count how many times they pass the ball. The ladies with the white t-shirt pass the ball. That's your only task for this very short and brief test here. Okay, let's go. Okay, this was a test. The question is, how many times, you can type it in the chat, how many times did the white ladies with the white t-shirt passes the ball? Great. Some more? Come on guys, don't sleep.
15 times.
Good. Good. No, I can't replay. You can. By the way, it's Jonas, you can't. Yeah, that's okay. That's okay. But the main question remains. There is one main question which remains here. Did you notice the gorilla? Good. 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 I mean that this is a very old test, but it's always interesting. Great. So what this test is about is to show us that we can focus on 1,000 things or other things, especially in trading, seeing the smallest signals, but we don't see the whole picture. That's the selective attention test by Simmons and Chabris. Which is really worthwhile to see. It's funny because we want to see the gorilla. We want to see the gorilla, and this is the big players, and not the smallest signals, not the smallest whatever we have here on our chart. That might be of interest, but it's not our task to see every small signal or follow maybe a crosses of MA, moving averages, or what indicators we have. We want to make money. That's our goal. And what I'm presenting you is simply a system where you can focus yourself on the market without any without complicated and whatever signals you might have, indicators or whatever add-ons you might have. It is simply a really great signal. We have to discuss in the next 1.5 hours about the finer entries, the fine-tuned entries, and how that might work in the market. And then we will have a really good and complete picture about the whole market. Okay, great. Any questions so far? Okay, great. Coming to the strategy section, I hope everyone is on board here. And you can hear me as well, so hopefully, can you type on Y? Can you hear me? Just give me a signal to check that everything is okay. Okay, thank you very much. That's fine. I just want to proceed and finish this day with a strategy section, where I think we should have a look first at the macro view. That means we should understand where the market is trading, what the market is doing. So the first one we should see on our chart is watching the liquidity. That's the first view we should have. But I'm not sure who it was. I think it was Reimer who mentioned that we can fall in love with liquidity, and that means the liquidity on the chart. When we start, we see liquidity at 47.12, 47.12, 47.07, 47.05, really long-term high liquidity resting in the book here, and we maybe are, or yes, how to say, maybe we're maybe seduced to say, okay, the price is going or will go straight up there into 5 or 7 and 12, and then we might say, okay, if the price goes to 12 or whatever it is, what price it is, then we have to go long. That's by no means. When you're watching the market every day, then you will see that the long-term high liquidity may rest in the book for days and weeks, and that's normal. That we saw that at 46, I think it was 46.50, where the long-term high liquidity was resting in the book for weeks, and the market traded against 46.50 or 20 or whatever, dropped down and came back, and then dropped down again, traded lower, and then finally after 2 weeks they hit 46.50. So that's not a conclusion where we should say, okay, this is really something we can't rely when we see liquidity, but it gives us a great idea what the market might do. Today we have had, I'm not sure anymore. Oh yeah, 47.13, 47.12. Yes, that's what I'm watching. Was watching at 47.12, 47.13. There was a big liquidity there. They added at 06, 07, and you see what happens. This guy was sitting at 47.12, and you see by the color or with the color here, the color was or is. What is this? Red, orange here at 12, and then he is canceling the liquidity around 12 here. That's a very nice and beautiful sign that this guy who wants to trade at 12 or 13 here at this level didn't await the price to coming back. Oh yeah, he is adding here again. Oh, he starts to add. That's interesting. Watch here. As we saw on the volatility indexes, the price dropped very hard at the beginning. So if you are short for 46.90, you got or have been short blindly based on the volatility indexes, then you got what's the theoretical outcome? 10 points, maybe 10 points here out of the first move. Then we saw a high volume traded here into 46.81 at 15.51 my time, indicated as well as a kind of it's not a stop run, it's simply a high volume traded here in the 51. It's, as mentioned, this indicator is very similar to the SI or the stop tracker of SI tracker here, of Bookmap's SI tracker. It's very similar, so you see that here, very high volume traded, then it dropped down again, retested this area, and then building a divergence as well here. We talked about divergence. You can read divergence based on the Market Volume Pro. That was the traded volume between, you can measure that as well, minus 793 into 2,440. That means 1,800 contracts has been traded here at what is 10:51 Eastern time. 10:51 Eastern time. You can measure the volume by hovering the mouse on the MVP. In this case, you will read minus 770, and the tip and the bottom of this of the MVP of the Market Volume Pro is at 2,440. Let's zoom in a little bit to see it really hard exactly what happens. High volume simply was traded here. Let me see if I can catch that better. Minus 800, and the low was at 2,400. That means between here and that time there have been traded 1,700 contracts. That was simply a sell-off into this area. And when you see this big sell-offs, I'm not sure why the Market Explorer didn't show up here. maybe the time. I have very straightened the time here. So when you see this volume trading here, very high volume, exhaustion as well here based on the price dynamics, then yes, that's here, the volume spike. You see exactly what was traded here at that point. Nice signal to be alerted that this might be really something you should tighten your stops, maybe taking your profits off the table. And a very nice signal came up here, 966 traded again. That was a really nice, but a smaller volume spike here as well. So you have very nice signals based on TradeFinder, which are showing you the swing highs and the swing lows. And we are looking for the swing highs and the swing lows, as well as the divergence that was extremely nice and well. So what we are looking at is liquidity as the major point anchor, the major anchor for us to understand what the market might play today. There's no rule and there's no guarantee or whatever. There's no rule or no guarantee whatever that liquidity will hold, that will resist or will stay there. It can be cancelled, as you know. Liquidity can be cancelled, as you know, very, very easily, and or fast as well, and they can resist. So our first view is to understand, and by that I'm meaning not on the future. Let's have a look at the UV. We talked about that. When we started, we saw the big liquidity here, then they have been added here, then they added liquidity at 1501. That was the next liquidity level, which was added at 1490 roughly, and they're adding liquidity right now at 1490. So, but that's now during the market. Let's have a look at Apple. I have Apple somewhere here. Yeah. You see how fantastic TradeFinder works here. That's what we want to find. We want to find this huge swing highs and swing lows. And when you're trading Apple or when you're trading stocks, the same principle applies. Absolutely same principle applies. You see, you start to, you open your chart, you get a first impression of the instrument, which is we have an extreme high, or we have high long-term high liquidity at 153 with 290,000 contracts, 290,773 contracts. Look here at that one. And that is the attractor for the price. The first level we have at 152. The second was at 152.20. And the next one was 152.50, and the next is 153. So this is important as well. You might trade stocks with options. And if you want to trade them as well, you want to know where the market is most likely to go to. Well, what is the direction? What is the direction of the market? Where will the market trade? So you will need to buy a call with a decent premium, and then maybe taking your profits here on the way up from 151.60 into 152, 50 to 60, whatever it happens. Then you see really nice icebergs hitting at the top and as well here. Let's see Tesla to prove our theory as well. Yeah, come on. The imbalance line. Tesla as well, the same picture. I'm absolutely sure you understand. You are totally understand. You totally understand what I wanted to say, what I wanted to suggest, and what I wanted to say here is it's the same principle. The big picture is based on liquidity. The big picture is based on volatility and the options. That's the big picture we have to have. So you see liquidity there. You find nice volume spikes. We talked about volume spikes, which are kind of exhaustion. You have to go against them. You have to go against them. Let's see QQQ if you find something. I will ask Ed. I will answer your question. That imbalance line. I'm not sure what you mean by the imbalance line. Maybe of TradeFinder thing. Yeah, that's if you see the QQQ, you see liquidity as well. It's much harder to follow the liquidity on the QQQ. You see all this small fractions of liquidity up and down. That makes it really hard. To follow and to understand. But you see as well big liquidity, and the next liquidity level is 400. If the theory is right and they are trading now here, and that might be, you see the volume spike as well. Some would say that's a stop run here into QQQ at 398. And because this was a long-term high liquidity sitting on at 400 and as well 401 as well, that might mean that QQQ will trade into 399, 400 and 400. Oh, it was cancelled right now, 401. You see, it's a little bit more harder to read it. It's a little bit more harder to read it here, but the trend is, at the moment, the trend is up. They added 20,000 at 398. It's more harder to read it here on QQQ. Let's see, what do we have?
Walter, just wondering, the imbalance line, I mean, it's on the bottom right of the chart. Yeah, I don't know if it's market volume growth.
Yeah, that's this line. So what we added is, by this line, it means the imbalance, the book imbalance. We talked about very briefly in this seminar. The order book imbalance is on the ask side. I don't know why I don't see at the moment. Yeah, it's much harder because you see this red channel here around the price. It came up again today. It makes it really hard for the imbalance tracker, based on the settings you are doing or you are setting in on your chart. What I want to see is the TradeFinder should watch for imbalance from the BBO, that means the first price level, to the 1880 ticks, that means 20 points in ES. That means this is the range from here. Yeah, I don't know. Yeah, from here, 20 points up and 20 points down. And then I expect a signal on chart which shows me, okay, the imbalance is on the upside or imbalance is to the downside. We go to the documentation. I have put some links, some sources which describes the phenomenon of order book imbalance very good. And if you are interested in imbalances, by the way, the most other charts like Ninja and Sierra has their own imbalance counters. You will see that where the imbalance is, given the imbalance to the upside is higher than the imbalance to the downside, which is now indicated here by the imbalance line here. That means the imbalance, the liquidity on the upside is higher than the liquidity on the downside. This is the meaning of the imbalance line here. The market should go towards or to the imbalance in the book. That's the theory, and that's what is behind the imbalances, order book imbalances. I think I have put some links in the documentation about the order book imbalances. It's not the strongest point, the strongest signal, but it keeps us aware that on the upside we have more liquidity than on the downside. So the price might now trade into 92, and at the moment we don't know whether this is maybe will be repellent or will be resistance in this case, or maybe the market is so strong to break through this 92. But the fact is the imbalance on the upside is higher than the imbalance on the downside. That's indicated by this imbalance line. On the other side, you should get I don't know whether I can reproduce that because it's extremely hard. Let me see if I can do that here.
So this is separate from buy imbalance, buyers imbalance, and sellers imbalance, correct? Or
resting, yes, it is. It is always calculated on the resting, on the liquidity, on the resting side of the book, on the ask, on the sellers in this case, yes, and on the buyers in this case, yes. Now you see it comes up here. That's, you see this. What is this? Red triangles showing to the downside in this case, because I'm simply only saying to the program, watch for the first 20 levels, 20 ticks in this case. 20 ticks means 5 points in ES, 5 points in ES. So TradeFinder is now watching 5 points from the best bid offer. Where is the next? Where is the higher imbalance? And according to theory, imbalance theory of an order book, price seeks liquidity and price tends to trade against the imbalance. That's the theory, and that's why we invented or added the imbalance tracker to Bookmap or to the TradeFinder, just to give you an idea where the imbalance in the book is at that point, and it might mean that is an additional signal that the price is going in trading against liquidity. I'm using only native icebergs in ES. Chris, I'm using only native icebergs in ES. No, MBO, we don't have MBO data for stocks. No, we don't have MBO data for stocks. We use let me say Apple. Where is the Apple here? We are using synthetic orders. They are calculated mathematically based on a certain analysis to indicate the synthetic icebergs. There are no native icebergs in any stocks in any ETF or whatever. Here there is a dynamic hidden order plot, and it indicates synthetic orders. Disobey or disregard the price dynamics plot for stocks. In this release, we have to do more research on how to define the price dynamics plot for stocks. That's really a big challenge. Not sure if we can remain in that. How about stocks? How about how to determine size for stock right? Yeah, it's based on by doing, Chris, simply by doing. So if you have a high traded stock, look here, we have an average volume in Apple market volume, that means aggressor volume of 30,000 at the moment, 30,000 of a period of 20 seconds, and we have an average liquidity on the first 50 ticks about 22,000. So that means the hidden orders or the synthetic orders, icebergs, must be somewhere 10,000, 15,000, 20,000. There is no fixed rule, and we can't provide for every single instrument. It doesn't matter whether it's an ETF, it's a future, it's a stock, a good number, because it changes constantly every day. If you are not satisfied with 15,000, changes to 20,000, and get an approximation what you want to see, what's of interest. You want to see the big one. You want to see the big whales in the game. That's what we want to find. We want to understand where's the liquidity. This is adding liquidity and acts as a support. We want to see the big icebergs, and when we have them, when we identify them, I don't know what the best number is now for Apple. I think it's for 15,000. Sorry, I have to activate it again. Then only the biggest one with 20,000 will be identified here on chart, and that might give you an idea and clue what the best settings is. There's no rule, there's no whatever. You look here, this is a synthetic iceberg which was traded into 152.30, and its size is 35,000. 35,000. So no, I'm not using. I'm watching Fangmans, of course. I will talk to that in a moment, but I'm not using them. That's too complicated. I just want to. I'm simple man. I just want to make money, and I just want to know where the market is heading. And when I see such nice sweet spots like in ES, for example, here, I know the market is straight down from the opening because of the discussed volatility indexes. It goes down. I'm simply joining the bid here. Or I'm joining the market, whatever, or the bid, and I'm selling, or I'm joining the ask. It depends on what you want to do. But you can't concentrate on every simple, stocks and Fangmans. I'm watching them, of course. I have them on the Ninja Trader as well, seeing what Facebook, Google, and so on are doing, Apple, Microsoft. But overall, are they leading or not leading? That's a question, but not how many icebergs. The only exception is that if you are trading stocks, you should have this tools on the chart to understand better where might be the high swings, and we want to see high volume traded where exhaustion happens, where a break happens, or we want to see high big icebergs in the swings, like here. Wonderful signals here which indicates high volume traded, 2059 traded down here, as well indicated in the MVP Market Volume Pro, and again the next one, which was a perfect entry signal. And then you see, let me see what time this is here. 1600, that means 4, that means 10. Let's have a look here. Oh, that's great, guys, come on. Just to wake you up based on our discussion. Do we need these signals? Yes, I would like to see the signals, but this is not the reason why the market is going. This is not the reason, guys. This is not the reason. Either you are using SI or whatever you are using. This is not the reason to go long here. This is not the reason, not whatever. Don't tell you anyone that this is the reason to go long. The reason to go long is here. So, and then when you see that, this is the divergence in the VIX. The VXX is not following as well. The UV is not following right now here, but the H8, it's hard to read. So I don't want to refer to the HYG, but you see what the VIX is doing here as well. 14. Let me see here in 5 minutes. 5 minutes.
Walter, what are the clues that the VIX won't continue rising? Like, what do you use?
I don't know. I can't say that at the moment. Let us see the UV. So the VIX is down here. It's building a nice divergence. You see that was 1600 my time here. That was the high volume traded, doing a double bottom here, doing a second double bottom here in the SPY. And let's see this is the same picture here on the S. We have 1600, and let's see where's the UV? Just a moment. I'm looking for the UV here. 1600. Where's the 1600? So that's the peak up here. So very hard to say why they are doing that. Why that happened, because the VIX is showing a divergence here, so that's dropping down and coming back. I don't know. I can't explain that why that happened. Maybe no, I don't know. I can't say that at this point. But what I'm noticing simply is this pattern. I see the price comes down. That was the high volume traded here. The signal was at 1600 my time, and then at that point the VIX was down. So if you're not sure, then wait and maybe join the move a little bit later if you're trading and not sure well, either to enter here or maybe a little bit later. But that's quite interesting here. Maybe I see this as well as the first time, that there is a peak up and then it breaks down. That's a very nice, that is a very clear divergence I see on the VIX, but not on the VXX and UVXY. So let's see in the VXX here. 1600. Yeah, it's the same pattern. It's absolutely the same pattern here. That was while the VIX was falling here. Those the UV and the VXX are making a spike up and then breaking down. So I can't explain that at the moment. I don't have any explanation. I don't know if we need an explanation for that, because I saw simply that and saw this double bottom here in the SPY, and ES was making a very nice volume spike here. And on the other side, when you're watching that, you see a very nice divergence between this traded high volume 2000 versus 469 and this volume here 966 in one versus 199. That's a very nice first divergence. We have a nice signal here, and we have additionally where is it? We have an additionally divergence in the VIX here. Although you are right, it's not a perfect signal. You're right, it's not a perfect signal. Good. Let's go ahead. The macro view, we want always to know where liquidity is in the book for stocks, for ETFs, for especially, I think from my point of view and what I'm talking to other traders, friends, is that it's sometimes much easier to trade stocks than futures, because you have a very clear picture of liquidity. Yes, you have the UV, you have the ES, and you have here the VXX, just to give you an idea what's possible when you see liquidity there, and you see liquidity then mostly on of the time in the ES on the lower side. We see then liquidity on the upper side on the UV and as well and the VXX. That gives us really a wonderful picture, a wonderful first impression what the market might do. So the question of I think it was Chris, was do I watch FANGs? Yes, I'm watching them. They are part of my market overview. As you know, liquidity acts as a magnet. Liquidity is providing or taking energy. That means absorption, book flipping, and support and resistances we will see along the day. We see order book imbalances, as just mentioned, based on the question from, I think it was Ed. Order book imbalances are really good described if you follow the links I've put in this documentation to learn more about order book imbalances. And as I showed, NT has an order book imbalance chart. And as well, I'm sure any other Thinkorswim or Sierra, it's really common today. That's nothing really special. And we should use liquidity as our guidance orientation throughout the day. That's the main goal of when we try to get a picture. And that's what Ed asked is, yes, we must watch the FANGs, the broader market. The Microsoft, the FANGs making 45% of the NASDAQ. 3.8% or 4% of S&P and 28 or not 29% of Dow Jones. We can't miss them. I have one indication which shows, or if you are using NinjaTrader, you have you can add the FANGs to a chart and see them. Let me show if I can. Can you see my screen right now here? Do you see my market watch? Can you see my market watch? No? Okay, I'm back. It doesn't work here. Hello, I'm back. Can you see my screen, please? Can you see my foil, my chart, my presentation? Okay, I'm not sure if this works, but I have a market watch on NT, NinjaTrader, and as well you have your own market constellations, and you should have a look whether if the FANGs are leading or not. That was the question of Ed, I think it was. So yes, I'm watching them, and as well I'm using the ADD. That was the question before. By Eulers and Tick as well. So that's the overall market. That's you need to know the condition of the market, what the condition, in what condition the market is, and then you can decide to go on further. You see the downside is leading. So that makes you puts you in the position to say, okay, where should I take my trades? So the first point is get an overview. You do the detox week. I really would like to motivate you to get a really excellent picture about your market without having any indicators. I know we fear being without any guidance because we need a kind of insurance. But every indicator we have on the chart is a lagging indicator. That's the problem we have. And every indicator on the chart we have, and when we come together, we will discuss, and every one of us will have a different opinion what the indicator is doing and what might be the outcome now of the next one, and what happens with the price. It's going up or it's going down, or with the market it's going up or it's going down. There's a lot of interpretation in all these indicators. When we try to understand the dependencies in the market, the correlations in the market, then it will guide you far better, because you see, I'm resisting to have any indicators here. We could have the RSI, because like in this attention test we did, where the big gorilla came in and we are focused on counting the ball of the passes of the ball passes in between this group, it distracts you. So we are watching the RSI and saying, okay, it's building a divergence here, but you see the divergence with your own eyes. You don't need anything else here, really, because we are not trained. We are not trained, and we are not used to be without indicators, because it causes a really weird feeling in ourselves. So we just don't see anything. We don't have any insurance. We need that and that and that signal. We are not using it. But when you are trying to detox yourself based on the indicators, then you will start to learn to see the market more as it really is. And there are really good helpers. We have this for the futures. We have this system for the Nasdaq. We can use it for the Russell, although we'll be very cautious. The Nasdaq can lead sometimes based on the FANGs, because they are making 45% of the Nasdaq, and that's really something we should keep in mind. Get rid of the indicator. No, excuse me. No. Reduce the usage of your drug. So that's what I wanted to say. reduce the usage of the drugs and see what really happens in the market. It will lead you far, far better than any drugs you are using. Okay? Yeah, cold turkey is not bad. Excuse me, I'm provoking a little bit. I just want to shake and to wake you up, to show you, yes, every one of us, not only we here in the group, but any other traders here around all over the world are coming from this, or having made the same experiences. Made the same experiences as we, because we want to be rich, we want to be famous, we want to be handsome, and that's our goal. But there are only, so far I read, only 5% which are constantly making money in this business. It's about confidence, yes. It is about confidence. We need a kind of insurance every single time. Okay, now when we understand that we can work even with without indicators, I'm saying that very cautiously. To understand the market, we have liquidity, we have the dependencies, the correlations of the named markets, how they work. We can now trying to find the best entry. To reduce the reduce the risk we have, and enhance the reward. That's the point. That's another challenge, and that's really a hard challenge for every one of us. I'm calling this stuff to find a nice spot, the sweet spot. I'm calling that a sweet spot because a sweet spot means you are in the game before the market lifts off or trade in a direction, to be in the saddle, to be in the market when the market starts to trend. That's the idea behind. So you see a very nice example here in the book map. This is a sweet spot here, wonderful, indicated by TradeFinder, as well as the Market Volume Pro. It's a perfect coexistence between Market Volume Pro, which is the stop indicator of the SI indicator, indeed this one, and the TradeFinder. It's wonderful. You don't. That is, by the way, who does not have the Market Volume Pro. It's a one-time fee. You don't need to subscribe. It's available on Bookmap marketplace here. So that's a perfect entry. That would be a sweet spot. Why? Because first of all, there are 3 reasons why that could be one or was one. In this case, it's hindsight, but anyway. We saw a divergence or starting divergence here in the VIX. We didn't see that in the VXX in